Hi everyone, welcome to another lesson from Lesson Up Squad on cash flow notes today. So before we start the lesson today, if you haven't watched the first video on cash flow, I'd suggest that you please watch the first video because this is a continuation of the first video. I'll link the first video in the bio below. Great stuff. What are we learning today? We're going to be learning the basics of what is a note, 6 easy steps to approach a question that does not require a note, how to use the above steps and convert it to a note, and 3 easy examples of how to do the note. So let's get down to the basics. What is a note? It's very important to understand what a note is, and you'll understand this why later in the video. Notes are a breakdown of the value on your financial statement. So they actually show you what that value on your balance sheet or income statement is made of. As an example, I have a balance sheet on my left hand side. You'll see that the example I have chosen is the PPE example. On my right hand side, I have the PPE note. Both of them, the value is the same as I've highlighted in yellow. The right hand side tells you what the value is made of. So basically what the 9.58 million is made of. Whereas the left hand side will give you the summary on your balance sheet. Let us get to the most exciting part of the lesson today. 6 easy steps to approach a calculation when you don't have a note for a cash flow. Number 1, indicate clearly your current year and your prior year numbers. So that means take a pen, take a highlighter, write it down carefully, show it on your question paper so that you are aware which ones are your current year numbers, which ones are your prior year numbers. Number 2, always draw a T account, no matter what. Even if you require a note, draw a T account. It will always help you find your missing figure. Number 3, bring down your opening balances on the correct side. Number 4, determine what else happened with that account during the year and bring down that number on the correct side of the account. Number 5, balance your account. Number 6, find your missing bank account number. Your bank will be your cash amount, which is the amount that you require for your cash flow. Remember, we are doing notes to the cash flow, which means we have to keep our mind in the cash flow perspective mind. So you've got to consciously be aware that you'll need to look for the cash amount, unlike doing your other financial statement notes. So let's look at an example of an income tax and dividend note that you'll commonly do. In this example I've shown you, we do not have a balance sheet, but we have a note. The note once again is a breakdown of of your balance sheet. So here you can actually see more clearly of what the amount on your balance sheet is made of. So let's do step number 1. Clearly mark your current year and prior year. Here you see I've actually on my notes I've marked the balance last day of the previous year, I've marked my last day of the current year, and then on my trade and other payables I've actually marked 2014 and 2015. You can use a highlighter to mark this, circle it with a pen, whatever brings it to your attention. So step number 2, draw a T account. Simple. Step number 3, bring down your balances. So here you see we're doing the income tax liability note. I've brought down my balance of 12,400. Income tax was a liability. I needed to pay it off. I could see that from the notes because the notes said trade and other payables. That means I was meant to pay SARS. I've brought down my opening balances and my closing balances on the correct side. That's step number 3. Step number 4, what else happened during the year? You had tax for the year that happened during the year, which you need to pay and account for. Therefore, I will bring that transaction from the income statement onto the correct side. That will be step number 4. I will then balance my account. That is step number 5. As you can see, I have now balanced my account. The higher side is what we aim to achieve to. We will therefore take the 134,400 minus 10,800 to get to the missing figure, which is your bank number. That's 123,600. Voila! You've actually calculated your income tax liability bank in 6 easy steps. We will now use the same example that we did and convert the T account into a note in 3 easy steps. Step number 1, draw your T account. Step number 2, draw the format of the note that you're required to do. The format never changes, right? You've always got your opening balance, your closing balance, and what happened in the current year. Step number 3, which is the cool trick. If you notice, everything on the credit side of my T account is in the same direction. So you'll see 122,000 and 12,400 are both on the credit side of my T account. You'd put them in the same direction in your note. The 10,800 is on the debit side of my account. Therefore, you'd put it in a positive form. You still get 123,600 Rand bank amount in your note. That is why it's important to do your T account so that you can easily do your note. It would take you a minute or two to complete your note after you do your T account. Let us now look at another example of a cash flow note, which is a very common one, shareholders for dividend. Step number 1 was to make sure that you've highlighted and made conscious of yourself of the current year and prior year amount. We've already done that. We're using the same information from the previous slide. Step number 2 was to draw a T account. I've drawn my T account for shareholders for dividend. Step number 3 is to bring down your balances. This is very easy to do because bringing down your balances, most of the time you'd have this information available to you. And also when now you've highlighted your current year and prior year, you would know where to put the value and which value to use. Determine what other transaction took place in the account. This is an account for shareholders for dividends. What happens in that account? You declare dividends. You would therefore need to find the value of dividends that you've declared, which is 120,000. Step number 5 is to balance your account. Once again, we would add the higher side and subtract it from the less side. That gives you your bank amount. That is 88,000 Rand. This is the amount that will go in your cash flow. It is your bank amount, your missing amount. Let us quickly convert this into a note. You will see that the 120,000 and the 40,000, which is on the credit side, all of these are in credit, which means they are in negative in your note. They are in the same direction. So everything on the right hand side or the left hand side, when you put it into your note, must be in the same sign. So you can choose a sign. It can be a negative sign or a positive sign. It must be in the same sign. Anything on the debit side, 72,000, I put it in the opposite direction. You still get to the same value being your 88,000. Let us look at another example, which is your PPE example. In this example, you will learn how to calculate your accumulated depreciation and also to calculate when you've purchased an asset. This example is interesting because it also has an asset that you have sold. So, just as a given, every time you sell an asset, you will always deal with 3 accounts. Your asset account, the accumulated depreciation account, and your profit and loss account. That will not change. You will always deal with these 3 accounts. Once again, in this example, we do not have a balance sheet, but we have a note and an extract of an income statement. We will follow the same 6 steps we've previously followed to determine our note and our cash flow value. So with this example, I've already done step 1 in my previous slide where I've highlighted what's current year and what's prior year. That makes me conscious to make sure I put the amounts in the right side of the accounts. Draw a T account. Step number 2, I've drawn my T accounts. Step number 3, I'm going to bring down my balances. I'm going to bring down my balances for vehicle first. I can't do anything more in vehicles, but what I do know for step 4 is that 2 transactions took place. I sold an asset and I've purchased a vehicle. So I need to find those missing values. So I'm going to just do step 3 until now, and I'm going to use the help of the other account to determine step 4 for this account. Same thing, accumulated depreciation, I will bring down my values. I have been given, so that's step number 3. I've brought down my balances. Step number 4, what happened in accumulated depreciation? I've sold an asset and I have depreciation for the current year. So I was given the depreciation for the current year. step number 4. Now I can calculate the missing figure, the depreciation for the asset that was sold by balancing my account. Once again, you use the larger side and you subtract the smaller side and you would get your missing figure. That missing figure is the 21,000 that needs to go into our asset disposal account. We are going to follow the same procedure for the other accounts. I've drawn my T accounts, I'm bringing down my balances, and I'm going to now determine what happened with the transaction. So if you remember in our previous slide, we calculated the value of the depreciation for the asset that was disposed of. We can now put that value into our account. Be mindful, step number 3 under asset disposal, the 36,000 was given to me already. Then I've got my accumulated depreciation. Remember, I debited my accumulated depreciation, so I would credit my asset disposal account. Once again, I would balance my account. That would be step number 4. You see, I've determined my transaction and balanced my account here. Thereafter, I'm going to calculate my missing figure, which was the 57,000 vehicle. I will then put that vehicle value. This 57,000 will go into my vehicle account. This can already tell me which account it goes to. It will go to my vehicle account. I will now credit my vehicle account because I've debited this account. And there we go. After I've put that in, I have now recalculate my missing figure. I've balanced my account and I will be able to recalculate the missing figure, which is 315,000 Rand. As such, we've managed to calculate everything that was required in this example. Let us now look at an example of repurchases of shares. This is our last example for the lesson. Shares, I need you to remember this. Ordinary share capital account is always at cost. In this example, we've purchased shares. How do you know we've purchased shares? If you look at the number of shares at the end of 2014, we had 350,000 shares. Now we have 250,000 shares. So you can't think of it like an asset. If you thought this was an asset, you would have said, well, that means I've actually sold shares. You haven't sold shares, you've purchased shares. How shares works is you've got 350,000 shares in the market last year. This year you've got 250,000 shares in the market this year, which means you purchased 100,000 Rand shares. The retained earning note tells you that the purchase of the 100,000 shares was above average price, which means you purchased the shares more than what it was worth. So basically, the share was worth 1 Rand and you decided to go purchase it for 2 Rand from your shareholders again. Therefore, you've paid them more than what the share was worth. We've identified 2014 and 2015, your current years and your prior year. We now draw our T account, which is the ordinary share capital T account. We're going to bring down the balances, 5.6 million, which is your opening balance of 2014 and your closing balance of 4 million of 2015. We now have to determine what happened with this account. What happened with this account was you repurchased shares. This is the same value that is your missing bank value. Therefore, we now balance the account, 5.6 million, 5.6 million on either side. To balance the account, we say 5.6 million less 4 million, which gives us the balancing figure of 1.6 million. What goes in your cash flow is the 1.6 million that you paid plus the 360,000 extra that you paid. Or both of these will make your cash flow. Alright, so lastly, but my favorite part of the lesson, golden rules to remember. Remember, these are cash flow notes, therefore we think from it from a cash perspective. T account is the easiest method to get to your cash value, not the note method. The T account you will always do is for a balance sheet to find bank. You can use your T account to do your note. I've just shown it to you that the debit side value must all have one sign and the credit side value must all have one sign in your notes. You will still reach the same value. Most of your information is available in your balance sheet. But any value that you see in your balance sheet is not cash. So you can't use your balance sheet and put that value into your cash flow account. That will be completely wrong. Remember, information can be presented in different ways, but if you understand what you need to what you need to get to, and you understand what you have available, you will be able to get to your answer. For example, if you understand what a note is and what a balance sheet is, you will not necessarily require a balance sheet to calculate your cash flow amount. You can get your numbers from your notes. Asset disposal always has 3 accounts. Ordinary share capital account is always at cost. The profit must be separately added to your cash flow. That's all for today, guys. But please, if you haven't subscribed to our YouTube channel, please subscribe to our YouTube channel. Follow us on Instagram. Message me to be added to my WhatsApp group list. And most importantly, please share this initiative. It is a free initiative for everybody to get accounting assistance this year. Thank you so much for watching. Take care. Until next time. Bye.